Good day, students. You're welcome to ILODS lecture series. I'll be taking you through a quick tour on ACT 316 Managerial Economics. This video is for study session 5, Techniques of Profit, Costs, and Revenue Functions. Let's try to introduce you to the course. The scope of managerial economics extends to some economic concepts and tools used in analyzing the business environment in order to seek for solutions to practical business problems relating to profit, cost, price, and revenue functions. After you might have studied this session, you should be able to explain the meaning and theory of profit. You should be able to explain profit maximization as a business objectives. And lastly, you should be able to discuss sales maximization as business objectives. Meaning of profit. The term profit means different things to different people. Business people, accountants, tax collectors, employees, and economists have their individual meaning of profit. In its general sense, profit is regarded as income accruing to equity holders in the same sense as wages accrue to the workers. Rent accrues to owners of rentable assets, and interest accrues to the money lenders. To the accountants, profit means the excess of revenue over all paid out costs such as manufacturing and overhead expenses. It's more like what is referred to as a net profit. Economics concept of profit is the pure profit or economic profit. Economic profit is a return over and above the opportunity cost, that is the income expected from the second alternative investment or use of business resources. Concept of profit. There are two major concepts of profit, which are accounting profit and economic profit. Accounting profit is the difference between the total monetary revenue and total monetary cost, and is computed by using general accepted accounting principle. In other words, accounting profit is the same as bookkeeping cost and consists of credit and debit on a firm balance sheet. Accounting profit can be illustrated as total revenue minus all the costs that are involved. So you can observe that when calculating accounting profit, it is only the explicit or book costs that are considered and subtracted from the total revenue. Economic profit. Economic profit takes account into both the explicit cost and the implicit cost. The implicit is also referred to as opportunity cost and can be defined as the payment that will be necessary to draw forth the factors of production. Opportunity cost is the income forgone which the business could expect from the second best alternative use of resources. The forgone income includes interest, salary, rent, and it's also called transfer cost. Economic profit is equal to total revenue minus explicit cost minus implicit cost. Explicit costs are costs that are involved direct monetary payment. Wages pays to the workers, rent pays to the landowners, and material cost pays to the suppliers are all examples of explicit cost. So now, profit maximization as a business objective. Profit maximization objectives helps in predicting the behavior of business in the real world, as well as in predicting the behavior of price and output under different market conditions. Profit maximization has two major theoretical conditions. We have profit maximization condition where the total revenue is equal to the price times quantity, and the total cost is equal to the sum of variable cost and fixed cost. We have first order condition and second order condition. The first order condition says that a maximum profit, marginal revenue must equal to marginal cost. Marginal revenue means the revenue obtained from the production and sale of what? Of one additional unit of output, while the marginal cost is the cost arising from the production of the one additional unit of output. Second order condition says that the first order condition must be satisfied under the condition of decreasing marginal revenue and increasing marginal cost. Derivative of first order condition. However, the profit maximizing conditions can be formulated as follows. We have the given profits to be maximized, where Q is our quantity produced and the P is the price. So we have the total revenue is a function of output. We have the total cost, which is also a function of output. Our profit will now be total revenue minus total cost. So now, in order to get the first order conditions, we have to differentiate the profit to get the profit with respect to the output is equal to change in total revenue with respect to output minus change in total cost with respect to output, and must be equals to 0. This condition holds only if our change in total revenue with respect to output is equal to change in total cost with respect to output. So now, to get the second order condition, we will differentiate the first order condition. When we differentiated the first order condition, we have marginal revenue. So now in this case, when we differentiate the first order condition, we have marginal cost. Now in this case, our marginal revenue will differentiate the marginal revenue and we will differentiate the marginal cost to arrive at the second order condition. Profit maximization example. Example 5.1. Given the unit price of a commodity as thus, P is equal to 100 minus 2Q equals to 1. The total cost of producing this commodity is defined by the cost function as total cost is equal to 100 plus 0.5 Q squared. Require apply the first order condition for profit maximization and determine the profit maximizing level of output. Let's try to work it out. So now we have the total revenue and the total cost. The total revenue as given is equal to price times quantity, and the price has been given, which is equal to 100 minus 2Q. So now you can derive your total revenue to be equal to total revenue is equal to 100 minus 2Q multiplied by Q, that is price times quantity, and our total cost has been given 100 plus 0.5 Q squared. So now what we try to achieve here is that we want to differentiate the total revenue to get our marginal revenue and our total cost to get our marginal cost. When you get the two, we now equate the marginal revenue to be equal to what? The marginal cost, to arrive at the maximum level of output. So now, change in total revenue with respect to output will now be equal to, since our total revenue, don't forget, 100Q minus 2Q squared. So now if we differentiate total revenue with respect to output, we have 100 minus 4Q. That is, this 100Q will now change to 100, and 2 multiplied by 2 will give us 4. We now decrease this by 1. So now that's our marginal revenue. If you differentiate total revenue with respect to output, you get marginal revenue. Then our total cost now, the TC with respect to output will be equal to, if you differentiate this, we give you 0. Then 2 multiplied by 0.5 Q. So in this case, we have only Q. 2 multiplied by 0.5, we have 1. Multiplied by Q, we have this. So now, profit is maximized. Profit is maximized when marginal revenue is equal to marginal cost. So now, what's our marginal revenue? Our marginal revenue is 100 minus 4Q. And our marginal cost is equal to Q. When you collect like times, we have 100 which is equal to Q plus 4Q, which is 100 is equal to 5Q. Our output will now be 100 divided by 5. When you divide through by 5, we have Q to be equals to 20 units. This is the output that we are asked to find. So now, since we have applied the first order condition and we got our Q to be equals to 20 units, so the next thing to do is to apply this thing whether this 20 units will fit the total revenue and the total cost now to arrive at profit. Now our total revenue, when you substitute this 20, our total revenue will now be 100 multiplied by 20 minus 2 multiplied by 20 square. 100 multiplied by 20, we have 2000 minus 20 multiplied by 20, we have what? 4 times 4000. So now the profit maximizing output is 20 units. Techniques of total revenue maximization. As discussed at the beginning of this study session, total revenue can be defined as total revenue is equal to price multiplied by quantity, where P is the unit price and Q refers to quantity sold. The optimization problem here is to find the value of Q that maximizes total revenue. The rule for maximizing total revenue is that total revenue will maximize at the level of sales Q, for which marginal revenue is equal to 0. In other words, the revenue from the sale of the marginal unit of the product must be equal to 0 at the point of maximizing revenue. The marginal revenue is the first derivative of the total revenue function. Example 5.2. Given below the price function, P is equal to 1000 minus 10Q. You are required to find the level of Q for which revenue will be maximized. So let's have the calculations done. So now, given that P is equal to 1000 minus 10Q. So now, from our previous knowledge, we discovered that total revenue is equal to price times quantity. So now, substituting our P for this total revenue, we have total revenue to be equals to the price is 1000 minus 10Q multiplied by Q. If you open the bracket, the total revenue will now be equals to 1000Q minus 10Q squared. So now the next thing to do is to differentiate these total revenues to get marginal revenue. The TR with respect to Q is equal to, when you differentiate this, we have 1000 minus, when you differentiate this, you have 20Q, which is equal to marginal revenue. And don't forget that the marginal revenue, the total revenue is maximized when marginal revenue is equal to 0. If marginal revenue is equal to 0, automatically we must equate this to be equal to 0. 1000 minus 20Q will be equals to 0. So we have 1000, we collect like times 1000 to be equals to 20Q. So divide through by 20 to get our Q. So we have Q to be equals to 50 units. So now, the level of Q for which revenue will be maximized is 50 units. Now to get our total revenue is equal to price times quantity. And our price has been given 1000 minus 10Q. And the Q is this. So now if you open the bracket, we have 1000Q minus 10Q. So now substituting this 50 into total revenue, we have total revenue to be equal to 1000 times 50 minus 10 times 50. So this we have 5000, 50,000 minus 2,000. Since total revenue is equal to price times quantity, so our total revenue will now be equals to 1000 minus 10Q into bracket Q. So if we open the bracket, we have 1000Q minus 10Q squared. So substituting this 50 into this total revenue to arrive at 1000 times 50 minus 10 times 50 squared. So we have this to be 50,000 minus this should be 25,000. So the final answer is 25,000 naira. The total revenue maximized is 25,000 at the level of 50 units of output. So this is a total cost function. This is an exercise for you. Suppose that the total cost function of a firm is given by total cost equal to 200 plus 120Q plus 8Q squared. Find the average cost. In this case, what you just do is to differentiate this total cost to arrive at the average cost. We have come to the end of this study sessions. Hope to see you next class. Thank you for listening.